The Intelligent Investor Book Summary. The Intelligent Investor, by Benjamin Graham, is a classic book on value investing, first published in 1949. The book emphasizes the importance of value investing, which involves buying undervalued securities with a margin of safety. Investors should ignore market fluctuations and focus on the intrinsic value of their investments. The book discusses the psychological aspects of investing, encouraging rational behavior, and avoiding emotional decision-making. It provides guidelines for stock selection, including factors like earnings stability, dividend history, and financial strength. The concept of a margin of safety is crucial, helping investors protect against potential losses in uncertain markets. Graham explains bond investing, risk, and return, and the importance of understanding one's risk tolerance. The book stresses the difference between investing and speculation, advocating a long-term, value-oriented approach. Diversification and portfolio management are essential to manage risk effectively. Graham warns against blindly following advice from financial advisors and urges investors to educate themselves about financial markets. Overall, the book offers timeless principles for successful and intelligent investing, promoting discipline, patience, and a long-term perspective. The primary objective of The Intelligent Investor, by Benjamin Graham, is to impart timeless wisdom and principles of value investing to the readers. 1. Teach value investing. Graham's main goal is to introduce the concept of value investing to readers. He emphasizes the importance of buying stocks and other securities when they are undervalued compared to their intrinsic worth. 2. Encourage rational behavior. The book aims to instill discipline and rationality in investors' minds, encouraging them to avoid emotional decision-making during market fluctuations. Graham teaches readers to think independently and not get swayed by the herd mentality. 3. Stress the margin of safety. Graham introduces the concept of the margin of safety, which is buying securities at prices below their intrinsic value to protect against potential losses. The objective is to help investors focus on minimizing risk. 4. Differentiate investment from speculation. The book seeks to help readers distinguish between true investment, which involves thorough analysis and long-term focus, and speculation, which relies on short-term market trends and emotions. 5. Educate on fundamental analysis. Graham provides guidance on how to analyze a company's financial statements, earnings stability, and other fundamental factors to identify strong investment opportunities. 6. Offer strategies for defensive and enterprising investors. The book caters to two types of investors: the defensive investor, who prefers a passive, low-cost approach, and the enterprising investor, who is more active and willing to put in effort to find undervalued opportunities. 7. Address psychological aspects. Graham discusses the psychological aspects of investing, emphasizing the importance of a strong mindset to overcome fear and greed in the market. 8. Promote long-term thinking. The book encourages readers to adopt a long-term perspective in their investments, avoiding short-term speculation and focusing on the true underlying value of their holdings. The Intelligent Investor, by Benjamin Graham, is a comprehensive book that covers a wide range of investment principles and strategies. Here are some key points from the book. 1. Importance of value investing. Graham introduces the concept of value investing, which involves buying securities at a discount to their intrinsic value. Investors should focus on the underlying value of a company rather than short-term market fluctuations. 2. The margin of safety. Graham emphasizes the idea of a margin of safety in investing. This means purchasing securities at prices significantly below their intrinsic value to protect against potential losses. 3. Mr. Market analogy. Graham uses the analogy of Mr. Market to represent the stock market. Mr. Market is emotional and offers to buy or sell stocks at varying prices. Investors should not be swayed by Mr. Market's daily mood swings and should make rational decisions. 4. Defensive and enterprising investors. Graham classifies investors into two categories: the defensive investor and the enterprising investor. The defensive investor prefers a passive approach and invests in a diversified portfolio. The enterprising investor is more active and seeks out undervalued opportunities. 5. Stock selection criteria. The book provides guidelines for selecting individual stocks. Graham advises considering a company's earnings stability, dividend history, financial strength, and valuation ratios. 6. Bond investing. Graham covers various aspects of bond investing, including understanding bond ratings, yield calculations, and evaluating the safety of fixed income investments. 7. Market fluctuations and psychology. Graham discusses the psychology of investors during market fluctuations. He advises against succumbing to fear or greed and advocates focusing on the long-term prospects of investments. 8. Risk and return. Graham explains the relationship between risk and return in investing. Higher returns are usually associated with higher risk, and investors should understand their risk tolerance. 9. Contrarian investing. Graham encourages contrarian investing, which involves going against the crowd when market sentiment becomes overly optimistic or pessimistic. 10. Portfolio management. The book offers insights into constructing and managing an investment portfolio. Graham advocates diversification and periodic rebalancing. 11. The role of advisors. Graham discusses the role of investment advisors and cautions investors against blindly following the advice of so-called experts. 12. Financial statements and analysis. Graham emphasizes the importance of understanding a company's financial statements and conducting fundamental analysis to make informed investment decisions. Overall, The Intelligent Investor teaches investors the principles of sound and prudent investing. It emphasizes the importance of patience, discipline, and a long-term perspective, providing a timeless guide for successful investing in the stock market. Here are some memorable quotes from the book. 1. The intelligent investor is a realist who sells to optimists and buys from pessimists. 2. The stock market is filled with individuals who know the price of everything but the value of nothing. 3. The investor's chief problem, and even his worst enemy, is likely to be himself. 4. To achieve satisfactory investment results is easier than most people realize. To achieve superior results is harder than it looks. 5. The true investor welcomes volatility. 6. The intelligent investor is likely to need considerable willpower to keep from following the crowd. 7. Individuals who cannot master their emotions are ill-suited to profit from the investment process. 8. In the short run, the market is a voting machine, but in the long run, it is a weighing machine. 9. The stock market is not a casino, but it can be turned into one very easily. 10. Investing is most intelligent when it is most business-like. Thanks for watching. Like, share and subscribe.